Hi, good afternoon, guys. It's Chris V here. Listen, I'm reaching out to you today. You are our American Funds investment account holders, but specifically, the reason we're reaching out to you, you're a select group that owns target retirement date funds. Those are target retirement date asset allocation funds from the American Funds. I'm just speaking to that particular segment of our client base today. So I'm reaching out to you because you've reached a level of critical mass where you can start thinking about diversifying to reduce risk and maybe seek some additional upside opportunity in the markets. And we're reaching out to you because we see as a team a couple economic indicators that are out there, and we're piecing together pieces of this puzzle. And we wanted to bring some perspective to you that might influence the way in which your money is managed going forward. It might be something you want to think about changing some and adjusting a little bit, and we can help you there. So here's what we're looking at, and here's what we're thinking. First, I want to remind you, asset allocation, generically, is the ratio of stocks to bonds. And as we're young investors, we want to be more heavily stock driven. And as we get older, we want to shift more money over to fixed income, the bonds. And what that does is help to, historically speaking, helps to reduce risk. So asset allocation is proven to reduce risk through diversification. And as we get older, shifting to more conservative asset classes. Now, that's all great. However, we've got a couple challenges working against us right now. You see, we've been a prolonged low interest rate environment, which means if you're in a target date fund, and you're getting older, aren't we all? You're getting older. What's happening is there's a gradual shift from stocks over to fixed income at a time where interest rates, if you will, are just starting to rise just a smidge. They're just starting to come up, but they've been so low for so long, and it's really tough to find return. It's tough to find yield in a low interest rate environment. So that's one challenge that right now may not be the right time to be moving more into fixed income just based on interest rates. Now, secondly, it may not be a great time to move into fixed income because we're faced with inflation. I don't know if you see it, but I see it everywhere I look. I see it at the gas pump. Prices have gone up. I see it at the supply houses, whether it's like a Home Depot, a Lowe's, Ace Hardware, what have you. I see it there doing home improvements. I see it at the grocery store. Everywhere I look, I'm seeing price increases. And that's called inflation. I don't know that I trust the government's CPI reports, but I feel like we're seeing inflation everywhere we look, restaurants as well. And so as we see this, we go, well, how does the government offset inflation? What monetary policy measures can they adjust? And usually it's tied to interest rates. But all the economists that we've been following, they all seem to support, and the government seems to be echoing this, that they're not looking to increase interest rates substantially for a couple more years. Now, that's really good for home buyers. That's really good for people who need to borrow money for the long run. Low interest rates are great. However, it's not really good for inflation. That really hurts retirees. And so that means we need our portfolio to be more stock driven because equities tend to keep up with inflation and outpace it a lot better. Now, second part to this, when we think about interest rates, we go as monetary policy when our economy experiences the next correction. All right, now think about this. Yes, we had COVID, but that came and went very quickly. That was not something that was economically driven. That was pandemic driven. Before that, really the big hits were the credit crisis and the housing collapse, right? We also had 9/11. That was a big hit. We also had Y2K and the tech bubble burst. But we haven't seen, and I know it's every time we go through a correction, it's usually spurred by something different. But we haven't seen a big hit like that in quite some time. And so I would look at this and say we're still in the longest bull market run than we've ever seen in the history of our country and our markets. And while I don't know that it's over, what I would say is from a preparedness standpoint, from a cautionary standpoint, diversification makes a lot of sense. And the monetary tools that the government used to be able to use, such as cutting interest rates, it's tough to cut them any further than they already are to help spur economic policy. You see, cuts in interest rates usually helps bolster up the economy, but they're already pretty low, so I don't know how much more they're going to be able to do. So why are we reaching out to you today? Well, as your account portfolio has grown, and although we've been pleased as punch with American Funds, they've continued to be best in breed with their target dates. They get amazing reviews, tremendous accolades. We are super happy with them. For some of our investors that are amassing greater levels of wealth, we think it's prudent to start talking about and thinking about diversifying to get different strategists, to get different approaches to money management into the mix. Stuff that's perhaps a little bit more flexible and not so rigid by prospectus, by design. So we'd like to have a conversation with you. You're receiving this video because we've already sort of gone through our database, identified you as an account holder that we might want to have a conversation together. And we want to figure out whether it makes sense to continue the course as planned, or if it makes sense to make a couple adjustments strategically to prepare for what may be around the corner. But we're doing this with both an opportunistic eye to look for where do we see more growth in this ripple effect of the economy post-COVID. So there's still opportunity out there. So we're looking at that, but we're also figuring out how might we better prepare for the next market correction, and how did you emerge? How do we help you emerge a little stronger? How do we as an organization emerge stronger as well, helping you with your portfolios? So I look forward to connecting with you. There's a link here on the email. I hope you'll click it, and let's schedule a couple minutes with our team, get you into the calendar, and let's see if we have a quick dialogue whether it makes sense to make any tweaks or adjustment to our trained eye together in conversation with you. We look forward to hearing from you. I hope you and your loved ones are all safe and healthy this spring, and look forward to connecting soon. Take care.